Welcome to week 7's third lecture. When we started this course, we looked at what was the role that financial markets played in the macroeconomy. And we basically commented saying that financial markets work as intermediaries and to bring together uh, people who have excess money and people who are in need of money, uh, and therefore they facilitate beneficial intertemporal exchanges. Some of them contribute to capital formation, some of them do not. After going through a series of lectures and material that concentrate on the micro foundations of financial economic decision making, now we are back to see what role financial markets, assets, asset prices, all these play in the macroeconomy. This basically brings us full circle to be able to talk about a newer area of research, which is called the macrofinance. It has been developing over a decade now, but came it became important after the recent financial crisis, which started in the housing markets. So let's see what we have here. So, how do financial markets affect economic activity? We know that they are intermediaries. We know that they bring savers and lenders together. We also know that they facilitate two important beneficial intertemporal exchanges, one which involves capital formation and one which doesn't. So, how can we think about what is the effect financial markets are having on the aggregate economic activity? It turns out that we can distinguish between the long term growth effects of financial markets and short term effects of financial markets. So, obviously, the long term growth effects of financial markets is basically using savings to finance capital stock in the economy. We not only need capital stock to produce new stuff, but we also need to replace the existing capital stock, which over the years depreciates. So, if you have well functioning financial markets, then they should lead to efficient capital formation in the economy. You also need financial markets to price risk and therefore facilitate financing innovation and research and development, because both of these activities do not have, or they basically have a potential to develop a stream of future payments, but right now it's just a potential. So, for example, venture capital financing looks at this, and also securitization of expected future returns from innovation, which basically allows the risk to be transferred to an institution or a person who is best suited to deal with it. What are the short term effects? Under the short term effects, one of the most important thing about financial markets is the ability of financial markets to or ability of agents, economic agents, to hedge against consumption risk using different financial securities in the financial markets. So, availability of insurance affects the magnitude and nature of savings. So, for example, if there is no insurance available, then I will have to self insure, which means that I will have to save a lot in order to insure against negative consumption shocks. But it also means in what way I'm going to keep the savings. If the savings are for if there is no insurance available and savings are basically precautionary kind of savings, then I would like to keep them as liquid as possible. And so something like which is easily convertible into money at any time could be a way to go. And therefore, probably I might be end up or I might end up putting my money into something like gold, for example. So, if people cannot insure against most adverse shocks, then most savings would be held in safe and liquid assets. But if you think about financial assets as claim on capital, then by nature, on financial assets are not always safe or very liquid or both. But when you have deeper financial markets, they allow for effective risk sharing and insurance. By bringing together the demanders and suppliers of credit, they make investment in macro sense, which is basically financing capital stock, and consumption based on credit possible. Hence, financial markets also have implications for aggregate demand. So, what do we know about financial assets as claims on capital stock? So, firms can finance two kinds of claims. For example, they could issue equity or they could issue bonds. Asymmetric information implies that debt will be preferred by savers as it forces the managers to put in effort. So, when it is difficult to observe the actions that the managers would take, then it is much uh, then it is much safer for investors to invest in in a security that guarantees them some payment. On the other hand, equity doesn't guarantee you any payment. It could give you a higher rate of return, but over a long period. However, in the case of an adverse shock, most of the levered borrowers, which means most of the borrowers who have already taken a lot of loan, their net worth gets wiped out. And this significantly limits their risk bearing capacity as a borrower. Now, this makes the effects of a temporary adverse shock persistent till the firm is able to rebuild net worth through retained earnings. So, here we are basically looking at how persistence of temporary shocks can affect the ability of firms to respond to adverse shocks and rebuild the net worth through retained earnings. Sometimes these shocks could actually be amplified. So, for example, the question that a lot of people have asked about the recent financial crisis that started in a housing market is that how could a shock that started in a very small portion of the housing market, which itself is a small portion of the total financial markets, cause a financial crisis of global proportions? So, this is what we exactly are talking about here: amplification of shocks. An initial shock is amplified if agents are forced to fire sell their capital. Fire sales is the idea is where you want to quickly get out of that particular asset or get rid of that asset. Now, fire sales obviously depress prices. If you are desperate to sell the asset today rather than waiting, then you will have to take a knockdown on the price. Margins and haircuts rise. Now, margins and haircuts is the idea that if you uh, how much of the asset's value you would get if you want to get a loan based on using that asset as a collateral. So if the haircut rises or if the margins rise, it means that if I have $100 security, before the haircuts and margins rise, I would probably get $90 loan on it. But when the margins and haircuts rise, it basically means that I'll have less than $90 of loan on a $100 security. So here we can see that the persistence of a temporary shock lowers future asset prices, which in turn feed back to lower contemporaneous asset prices. which erodes productive agents' net worth even further and leading to more fire sales. Overall, this contributes to inherent instability of the financial system. So, a lot of this is directly applicable to what happened during the financial crisis. So, there was a temporary shock that led to collapse in the housing prices, which wiped off net worth of a lot of people, which caused uh, sales of house prices, or basically consumers defaulting on payments for houses, which led to even further decline in housing prices and therefore also more fire sales. So a shock can be easily amplified if agents are forced to fire sell their capital. So how do we deal with the instability of the financial system? Or what are the implications of the instability of the financial system for the macroeconomy? To understand this effect, we need to talk about two kinds of risk that are associated with any market for any kind of asset. So there's usually a small exogenous risk, which is basically the risk that is not under your control. But endogenous risk, which results from interactions within the system, they could be sizable. The other kind of risk that we need to talk about is the liquidity risk. Now, liquidity is fragile. For example, we saw earlier that an infinitesimally small shock can lead to a large discontinuous drop in the price level and a dry up of funding, something that also happened in the recent financial crisis. Now, are secured financial markets or secured funding markets prone to these kind of fire sales? Looks like they are. We call them as collateral runs. So, secured funding markets are subject to collateral runs when collateral values drop and margins rise. The idea of a run is basically to claim whatever rate of return on a particular asset you have, or claim the return of the asset itself. So, for example, a bank run is basically a run on the bank of all its depositors asking their money back. But what about something like credit cards, which are basically unsecured loans? We of course know that unsecured funding markets are more prone to these kind of things, and therefore they are subject. But what they're subject to traditional bank runs, so something like counterparty runs, when they are unable to roll their debt. So you basically default on the payment. When you have a secured funding, your asset loses value as a collateral, and therefore you cannot raise the same amount of money as you before. So now we saw that the instability of the financial system, which comes out of endogenous risk, the risk that is created because the economic agents in the financial market interact with each other, and the liquidity risk basically create this instability, and that creates a systemic risk. There's a component of this risk which affects everyone in the economy, uh, irrespective of whatever characteristics the individual economic agents have. So, for example, if you are participating in a secured funding market, then you could express something called as a collateral run. So, for example, you want to raise some money and you are going to give certain financial securities as collateral. When there is a collateral run, the collateral values drop and the margins rise, which basically means that if you had $100 worth of the financial security, you could get $90 before. Now, probably you could just get $70 of funding. And the second way a systemic risk could be created is thinking about how the instability of financial system expresses itself in the unsecured funding markets. So these markets basically behave like traditional bank runs when they're subjected to the instability. So a traditional bank run is basically uh, a knee-jerk reaction of all the depositors to some financial news, creating crisis of confidence, and then all of them basically going to the bank and asking their money back. The same thing happens with unsecured funding markets because there is nothing that actually is backing up the funding that has been traded for. So, this is how the financial system uh, affects the macroeconomy. All right, so this is the last lecture that we are going to look at in this course. We started with the role of financial markets in the economy, as I said before, and now we are ending with how uh, financial system and its different components affect the performance of the macroeconomy. Thank you.